Hello and welcome to our Ask the Expert series of videos. In this video, we are going to explain what a bond is, how bond markets work, and how they affect wider financial markets. So let's begin with the basics. A bond is a type of a loan usually taken out by governments or companies and is financed by investors. We're going to be focusing on government bonds because they have the biggest impact on equity and currency markets. When a government needs to borrow, it issues debt in the form of bonds. Anyone can buy a bond, but they are mostly held by financial institutions and various types of funds. More recently, central banks have become an important player in the bond market, as they've been indirectly buying government bonds since the 2008 financial crisis in a bid to pump more liquidity into the financial system. So how do bonds impact the markets? Bonds generate a return on investment called a yield. Yields move inversely to the price of bonds. The logic is that when there is strong demand for a particular bond, its price goes up and this pushes the yield down, reflecting that it is a less risky investment. Similarly, when investors sell a bond, the price goes down, lifting the yield. This is because the borrower now needs to offer a higher return to attract creditors. Another determinant of bond yields is the interest rate set by the central bank. The yield on shorter dated government bonds, which typically have a maturity date of 2 years or less, are heavily influenced by the policy rate, whereas longer dated government bond yields are primarily driven by expectations of future economic growth and inflation. The yield on long-dated bonds is particularly important in FX markets because that is what traders refer to for determining interest rate differentials between two countries. For example, if the US 10-year bond has a yield of 4% and Japan's equivalent has a yield of almost 0%, it would favor a stronger dollar against the yen. However, the opposite is true for stocks. The higher the yield, the less attractive it is for investors to hold stocks relative to bonds, which are generally considered to be safer investment. This is why when central banks signal higher rates or start raising them, equity markets react negatively as yields rise. I hope this video helped you get a better grasp of bond markets. If you enjoyed watching it, please click on the like button. And if you have any questions you would like us to answer, you can send us an email at asktheexpert@xm.com.